Hello and welcome. In this video we are going to build and backtest a trading strategy published by the infamous JPMorgan. This Bloomberg article is explaining the strategy, so let's go through it together. JPMorgan Chase & Co. strategists have identified what they say is a near bulletproof indicator to strengthen the argument that stock markets are poised to rally. The buy signal is triggered when the Cboe Volatility Index, short form VIX, rises by more than 50% of its 1-month moving average. Last time occurred January 25. The indicator has proven 100% accurate outside of recessions over the last 3 decades. Let's take a look at how the strategy is visualized. So this black line is just the VIX development. Those turquoise bubbles here are the buying signals, and those red areas are just the recession periods. The lower part here is showing the S&P 500 index performance 6 months after a buying signal was triggered. Alright, let's take a look at what else they have to say. Data show the VIX signal has been triggered 21 times since 1990, with the S&P 500 index gaining an average 9% in the 6 months afterwards. Prior to January, the last time the indicator flashed was in November, since when stocks have fallen globally. We have everything what we need to build this strategy in Python, so let's get started. Okay, so first of all, we will need some libraries. We need yfinance to pull index data both for the VIX and the S&P 500. We need pandas for data handling, and we need NumPy for calculation purposes. Now let's pull index data for the volatility index first using yfdownload and pass the ticker for the VIX. Ending up with the data frame like this, so we are starting in the beginning of 1990 going until today. Now let's switch back to the article and check what we need to do. The buy signal is triggered when the VIX rises by more than 50% of its 1-month moving average. So we are going to calculate the 1-month moving average first. So we are just adding a column to this data frame, roll over the close column with a 30-day window and take the mean. So with that, we are just calculating the 1-month moving average of the VIX. So we're adding a column here, just calling that MA for moving average. Use VIXEF, close the rolling function, provide 30 days and take the mean. With that, we are getting a new column here containing the 1-month moving average. Now let's switch back again. So buy signal is triggered when VIX rises by more than 50% of its 1-month moving average. So we need to check this data frame and check if this value, so every row's value here, is at least 1.5 times the moving average value. Or in other words, if this value is 50% larger than this value. So we are creating a new data frame and just calling that VIXEF filtered. And now we are checking VIXEF, where VIXEF close is larger than 1.5 times the VIXEF moving average. And with that, we are getting a filtered data frame containing only those rows where this condition is fulfilled. So where the close is at least 1.5 times the moving average. Alright, now there's an issue with this data frame. As you see, we're getting consecutive dates, e.g. here. Reason behind that is the condition was fulfilled and then simply was also fulfilled the next day. So we need to put another filter on this data frame and check for a minimum distance of 1 month between every row. Therefore, we are taking the index of this data frame, transform that to a series, and apply the pandas difference function. So let's do that. Let's get the index containing the dates, transform that to a series, gain the dates in a series, and apply a difference function on that. And now we are getting the difference between those dates in days. So as an example, we have 1 day for 6th of August until 7th of August, right? Now, as you also see, we have a NAT value here. As we are comparing the very first row, we cannot compare it to anything, right? Because we don't have a value before the very first row. But we are solving that problem in some seconds. First, we are transforming those time delta values into floating values to make it possible to check, is this value larger than 30, to only filter for those rows where we have a minimum distance of 1 month. Therefore, we can use NumPy's time delta 64, provide day here, and as you see now we are getting the values in floating values, right? And now we can simply check for only those values which are at least 30, right? And with that we are getting a Boolean mask here containing false and true values. False if it's not the case, true if it's the case. Now, as I just said, we have to get rid of the very first false value, because the very first row is our very first signal, right? So we want to have a true value in the very first row here. So this is a manual amendment we have to do. So let's store that in a variable first. I'm just calling that series. And now we are just taking a look at the very first value here and set that to true, as this is our very first signal. All right. Taking the values of the series, we can now filter our data frame. So let's say VIX filtered and screen for the series values. And with that, we are getting our buying signals. So let's store that in a variable here, signals. And let's do some quality checks. So how many entries do we have? We can check that. Just taking a look at the shape, we are getting 21 rows here. So what does the article say? Data show the VIX signals has been triggered 21 times since 1990. So seems we did everything right? But let's do some more checks. Prior to January, which was January the 25th here, let's take a look at the very last row, which was January 25. Right, now we have prior to January, last time indicator flash was in November. So let's take a look. We have 26 November. So everything went better than expected. Now let's get to the interesting part where we are checking the performance of the S&P 6 months after those signals occurred. Therefore, we are first of all pulling S&P 500 index data and store that in the variable SPDF using YF download and provide the ticker for the S&P 500. And we are starting in the beginning of 1990. Ending up with a data frame like this. And now the logic is pretty much straightforward. We are just screening this data frame for those dates in the signals data frame, and we are just adding 6 months to this date here, or to each of those dates, and create sub data frames of the S&P 500 data frame and just accumulate the returns. And with that we are getting the 6 month returns after the signal is occurring. All right, so let's take an example for the very first date here, so 6th of August here. So 6th of August would be signal index and then the very first value here. So to show you how a subdata frame would look like, just calling that variable test here. And I would now use SPDF, where my SPDF index is larger or equal to the signals index. And with that, I'm getting all dates larger than this date, right? Larger than 6th of August. And I also want to limit this to the date 6 months after this date, right? So this date plus 6 months. And we need a pandas function, which we need to import first. Then do that in the beginning from pandas t-series offsets import date offset. And this function enables us to just add a certain amount of days, month to a particular date. So as an example, if I'm taking this date and add plus date offset month 1 as an example, so now I have 6th of August. With that I'm getting 6th of September and so on. So I would take 6 months here, right, to get the subsequent 6 months after the buying signal occurred, right? So I'm using this logic. So I'm taking this, so all the dates which are larger to the signal state and are smaller or equal to 6 months after the signal state date, right? So I'm just taking this, change the sign here, and add 6 months. All right. Of course, use right parentheses, my fault. So with that, we are getting a subdata frame. And you see, this is starting at the signal date and is going until 6 months after the signal date, right? And now to calculate the return, I just take the close column here and cumulate the relative price changes. Okay, so I have other videos on how you calculate and cumulate returns. I'm not going into details here. So I would take the close column, take the percentage change, getting the daily changes in this 6 month afterwards period, add a 1 to that, and take the cumulative product, and that would be my return of the S&P after the buying signal or the first buying signal occurred. All right, so I would make 7%. Okay, or you are just taking the product and get the very last value. So now let's take a look at the overall performance of this strategy by simply looping over all those signals dates, right? So we are using the exact same logic, but we are just looping over all those dates here, create subdata frames, and check for the 6 month performance after those buying signals. So we are storing the returns in an empty list, or we are creating an empty list and then we are just populating this returns list in a loop. And now we are just looping for I in range length of our signals data frame. And now we are just using the exact same logic here, right? So we are creating sub data frames, just calling that sub df, and take this logic here and replace the 0 here with the I. And this is just looping over all those dates in the signal data frame, and it's doing what I just explained to you. Now after the subdfs are created, we are appending to the returns list, and we are appending subdf close. So now I'm just doing this step, accumulating the returns of the sub data frame, pct change +1 prod. Now let's run that, ending up with our returns. Can take a look at the mean of that now, transforming that to a series. Take the mean. Is a good 6%. In the article we saw 9%, but you have to consider that we have more recent data, right? So if we are taking a look at the return series here, you see that the last 2 signals, so this article was from February 2022, right? So they couldn't calculate the return for the November signal and the return of the January signal. Both returns are not included there. And as you see, those returns were quite bad here, right? So let me show you that in a more readable way. So you see the November signal was yielding minus 12% and the January signal was yielding minus 7%. So one has to observe if this strategy is profitable anymore, right? Because we have 2 consecutive quite big losses here, right? Another thing here, so we have maximum drawdown was during 2008, so we can also see that here. So this is another indicator that we did the right thing, right? So this is our maximum drawdown, so we could take a look at the minimum here and would get minus 33% here, right? So of course there could be some more minor differences. Maybe they used a rolling window which is fitted to the month, right? Took the last 28 days for February and 31 days for month with 31 days. So there are some minor differences which also could occur. So if we would exclude the, let's say, the last 2 entries here, we would get 8%, right? So we are pretty near to the 9% they reached here. So this is definitely true. So if we would plot our returns here and take a bar chart as they did, you can give me a second. Yeah, so if we are taking a look at the returns here, you will see, so if I'm comparing that to this one here, so that would be this bar chart, you see that we have basically the same pattern here, right? So if we see that pretty large one, third one, here is our pretty large one, then we are going downwards here, right? So as we do here, then we have this huge drawdown, financial crisis as here, then we are getting 2 bars back here. But then for instance, we are deviating here a bit, right? So we have another negative return which they don't have here, right? So there seem to be some more minor differences, but overall we are getting nearly the same results as JPMorgan, right? With the extension that we are also considering the returns of the most recent signals. So yeah, that's already it for this video. I hope you liked the concept of the video. I am definitely looking forward to your thoughts on the strategy. Let me know if you find this kind of content interesting. And yeah, thank you very much for watching, and I'm looking forward to seeing you in the upcoming videos. Bye bye.